Hey everybody, my name is Dr. Winter. I'm a tax professor and tax attorney, and in this video I'm going to be covering Section 351. My intent is to provide you with an overview of Section 351, so that way you're more prepared for your exam, whether it's in class, CPA exam, or enrolled agent exam. So to make this work, what I'm going to do is I'm going to start out by talking about the general rule of Section 351, which is a mandatory non-recognition of gains or losses when you contribute property in exchange for stock. So I'll talk about the general requirements. Then I'm going to go ahead, I'm going to work through some of the more nuanced examples, such as services or an existing corporation that already has shareholders. And then what I'll do is I'm going to go through and I'm going to talk about what the basis is going to be for our shareholder and for the corporation after a Section 351 transaction. So that's our map. If this is an area that you're looking for additional assistance, I'm confident this video is going to help you better understand Section 351. All right, let's get started on this. So we're dealing with Section 351, and what Section 351 is it's a mandatory non-recognition of gain or loss. So if you have property and you're wanting to form a corporation, and you want to recognize a loss, then you need to make sure that you're not meeting the requirements for a 351 transaction. Because if you meet these requirements for a 351 transaction, you cannot recognize that loss and you cannot recognize any gain. Okay, so this is mandatory non-recognition if you meet the requirements. Now, we usually see Section 351 when we're talking about the formation of a corporation, right? So we have a shareholder, a couple shareholders who want to go ahead and form a corporation. So they're going to contribute, and you can see right over here, they're going to contribute property to the corporation. And in return, what they're going to receive is they're going to receive stock. Generally, what will happen is the amount of stock that they're receiving is going to be the fair market value of the property that they're going to be contributing. So if you put in property that has a fair market value of $10,000, then you're going to be receiving stock that's going to have a value of $10,000. So people usually want to be fairly compensated with that regard. Now, there are instances where there may be an existing corporation and a new shareholder wants to become a shareholder within that corporation. So you could have an existing corporation, and as somebody's trying to enter, they're contributing property to the corporation and they're going to get stock. But what we're going to have to look at is whether that's going to satisfy a Section 351 transaction, because as we'll see here in a second, you have to have 80% control. And we'll talk about that in more detail. So when I say that we have a shareholder who's going to be putting in property, right? So we have somebody who's going to be putting in their property in this corporation. Well, what's going to happen? Here we go, right? So we have our property right there. So what's going to happen is we have to determine whether the property or the contribution qualifies as property. And to be honest with you, most things are going to. There's a few things that won't. But let's look at this. So I went ahead and I put in here for property, right? What we have is land, land, equipment, cash. Cash is a common one. Somebody contributes $50,000 of cash and they get $50,000 worth of value of stock. But we could have put in land that has a fair market value of $30,000, and our corporation would have then given our shareholder stock valued at $30,000. Intangibles such as patents and goodwill will also satisfy the requirement for stock, and so do receivables. If we have receivables and we're going to contribute that to the corporation, then we're going to get the value back in terms of stock. All those things are going to work for purposes of property. So property is pretty broadly construed here. There's a few things that don't qualify. One of the biggest ones is services. If somebody is contributing their services, so they say they're a CPA and they're spending the first year, they're just going to be doing the books, getting everything set up, and they're giving fair market value of their service is $100,000, and they receive $100,000 of stock. That would be an example of services for stock. What will happen in that situation is our shareholder is going to go ahead and recognize ordinary income. It's as though the corporation paid them $100,000, and then our shareholder took that $100,000 and reinvested it back into the corporation. Okay, so the shareholder whenever they give service, will always have ordinary income that they have to recognize. But for purposes of Section 351, we're going to see that because it's not construed as property, they're not going to be added into this, what we call the control group. And we'll see that we have to have an 80% control. And again, I'll get into that in just a moment. So services, and then we have a shareholder note. That's where somebody's saying, hey, our shareholder's saying, I'm going to contribute a promissory note of $100,000. I promise you to pay $100,000. I promise to pay you $100,000 later, and in return, I want $100,000 of stock. Well, that promise to pay later is unsecured. Look, that's not going to be property either. Okay, that's not going to satisfy it. And the reason we care is if they're not putting in property, they're not meeting the requirements of Section 351, right? So, Section 351, you have to be putting in property for stock. So, we have to have stock, property for stock. All right, so for a Section 351 transaction, that's the first requirement, property for stock. The second requirement is we have to have 80% control. When we talk about 80% control, we're really referring to two different things here. The first one is going to be, do they have 80% of the voting power for the corporation? And then the second one is going to be, do they have 80% of the total shares outstanding? Okay, so those are going to be the two requirements for 80% control. So, and it's the code says immediately after the transaction. Okay, so as soon as we do this transaction, they're supposed to have 80% control. So if they gave property for stock and all of those that contributed property in return for stock, if we look at all their ownership and between all of those contributing, they have 80% control cumulatively, then we meet Section 351 and we're not going to recognize gain or loss. All right, that's the basics. So, what I want to do is I want to talk about 80% control in a little more detail because there's a few scenarios that could kind of trip you up on this. So, we're going to work through those scenarios. I'll give you an example, a short example for each of those so you can see what I'm talking about as we talk about the different scenarios. And then after that, we're going to get into the most complicated area, which is going to be to determine basis. But even when we're trying to determine basis, we're going to be able to breeze through that. It's not as bad as what it may look like when you're trying to read the content. Working through some examples and having somebody explain it can really help you. So let's go ahead and take a look at some of those unique scenarios relating to 80% control. Here are the four scenarios that we've been talking about, right, that relate to the 80% control. So in the introduction, I talked about the requirements for Section 351. And I said there are two requirements. And if these two requirements are met, we don't recognize gain or loss. So the first one I said is it has to be an exchange of property. And we defined what property was in a couple instances that wouldn't constitute property, with service being one of the primary ones. And then we said 80% control immediately after the transaction. So what we're looking at here is the 80% control requirement. So these all relate to the 80% control requirement. So we're already assuming that property was contributed in exchange for stock. Now, as I go through these different problems, what I'm going to do is I'm also going to highlight what our realized gain or loss is. And then I'm going to also talk about, okay, what happens if 351 doesn't apply? That's going to be our recognized gain in these situations. So I want to make sure that you're comfortable with what the general concept is and why we care about Section 351 as we go through these scenarios. All right, so in the first one, we have control immediately after the transaction. So if you read the code, it says that they're going to have 80% control immediately after the transaction. And I don't know about you, but 80% to me means right after the transaction. That seems to be a plain reading of the definition. Well, the Treasury Department and the courts haven't looked at it that way. They've been much more taxpayer friendly in this regard because they give you a longer period of time. They don't tell you exactly how long, but what they want to know is they want to know if you have evidence that shows this was part of a prearranged agreement that you and your other shareholders were all contributing this property in exchange for stock. If they have that evidence, then they're going to say, okay, that's immediately thereafter, because they recognize it's hard to take a property and change title to the corporation and to have all that aligned up perfectly in time. So it takes a little bit of time, but show them your minutes from your discussions, your initial discussions. Make sure you have uh, records that are detailing what the plan is prior to implementing the plan, and that's going to help you in case the IRS challenges your Section 351 status. So here's our first example. All right. Alice transfers land with a fair market value of 200,000 and a basis of 100,000 to Seminole Corporation in exchange for 40% of stock. Bob transfers equipment fair market value of 300,000, basis of 50,000. 3 months later, in exchange for 40% of the stock, Charlie contributes, let's say that's $50,000 cash for the remaining 20%. It wouldn't make sense for Charlie to be contributing 500,000 and only getting 20% when that's far more than what others are doing. So let's say that that was $50,000 for the remaining 20%. Does Alice and Bob, so let's forget Charlie who has 20%, qualify under 351? Okay. Well, if they do not qualify under 351, if it was not property in exchange for our stock and they do not have 80% control after this, then what happens is Alice is going to have to she's going to she's realizing $100,000, her fair market value of 200,000 minus her basis of 100,000. If 351 does not apply, she will also be recognizing that $100,000. If 351 does apply, she does not recognize the realized $100,000 of gain. And Bob, right here, Bob has fair market value of 300,000, $50,000 of basis. Well, what that means is that Bob has realized $250,000 of gain. If 351 does not apply, then Bob has to recognize that 250,000, which means Bob and Alice are both paying taxes on those. But if 351 applies, then no taxes are going to be due right away because we're not going to recognize this realized gain. That's what 351's designed to do. It's designed to prevent us from recognizing either a realized gain or a realized loss. So we're assuming that it was for stock. Everything else is fine. I don't see anything on step one, but the question is 80%. Well, we have 3 months separate the two between it, between their actual application, between when they executed the property exchange to the corporation. So if this is part of a pre-existing plan, if they can show, hey, here were our minutes and this is what we intended to do, they're going to be okay. That would fall under the immediate control. If they don't have any records detailing this, then they're going to have to recognize that realized gain. So as long as they have the records, they're going to be okay. This is an immediate transaction. 351 applies, no recognition of gain. Let's look at a second situation. Now we're looking at disposing of shares after a Section 351 transaction. So what we mean here is we've now created a Section 351, which means there was no recognition of our realized gain or our realized loss. But if we did not recognize that gain, how long do we have to keep the property before we can go ahead and exchange it or give it away to a third party? Right? So if we look at this example, Dave contributes inventory, fair market value of 100,000, basis of 40,000. So when I'm looking at that, I am seeing a realized gain of $40,000. So Dave contributes inventory. It has a realized gain of 40,000 to Badger Corporation for 85% of the stock. 2 days later, he sells half his stock to outside investors. Does Dave's transfer still qualify under Section 351? Well, Dave met 351, property for stock, 80% control, because it looks like he's the only shareholder, but even if he isn't, he still has 80%, over 80% control because he has 85% control. Now, after you met that requirement, you can freely transfer your stocks to others. You can sell them, you could gift them to your family, you can gift them to anybody you want. You have already met 351, and now you don't have to worry about meeting it and when you exchange the property or you sell it to another person. Dave will not lose his 351 status unless Dave was under a contractual obligation to sell that property. If Dave at the time of 351 occurred, if Dave had to sell those to the third party, well, then it wasn't really a 351 transaction because Dave is just trying to avoid recognition. So as long as you're not under a pre-existing obligation when 351 is created, then you can dispose of those stocks freely and you're not going to run into any issues. It will not disqualify you from Section 351. All right, let's look at the third one. Service is not part of the control group. So this happens all the time. You're going to get clients that come in. You're going to have like four clients that come in and they're going to be like, we're going to be putting in property. The first three are going to say, we're putting in property. Each of us are putting in property that has a fair market value of 100,000, basis of 20,000 each. So they all have like $80,000 of realized gain, but they don't want to recognize it, right? But there's three of them. They're going to be the three that are putting in property are all going to be 25% shareholders. You're going to have the fourth one who's going to be putting in services, whether they're going to be managing it, doing the legal work, doing the accounting work, setting up the computer systems, whatever it is. They're going to be providing services in exchange for the remaining 25%. So we have four shareholders, each worth 25%. But when that occurs, if somebody's only putting in service, we do not consider their shares part of our control group. They don't go to that 80%. So what happens is our three that provided property, together they only have 75% ownership. They don't have 80% ownership. They fail 351 because they do not have 80% control. And because they don't have 80% control, they have to recognize that gain that they were hoping to defer until the future, right? So they'd have to recognize that gain. So let's look at this problem. Emma provides services worth $50,000 to Crimson Corp. In exchange for 30% of the stock, Frank contributes property, fair market value of 200,000, basis of 100,000, in exchange for 70%. Do Emma and Frank satisfy 351? Well, from Emma's perspective, it doesn't even really matter to her because she's putting in service. And if you're putting in service, you always recognize ordinary income. There is no deferral for her. If it's service, you recognize that income. As you earn it, it's taxed. It's as though you received the money and then you wrote a check to the business for cash of $50,000. Okay? So it's not going to particularly hurt Emma. But from Frank's perspective, Frank had fair market value of 200,000 and a basis of 100,000. Frank is going to realize $100,000 of gain. And now, because Frank only has 70%, Frank is going to have to recognize that 100,000 because we do not include Emma's 30% because all she did was contribute services, not property. So we don't use her 30% to help Frank out. So sorry, Frank, you're going to have to pay taxes on that $100,000. If you want to avoid it, if you want to help your client avoid this, then here's what you're going to want to do. You're going to sit there and you're going to say, hey, Emma, you need to put in some property in addition to your services. And there is a safe haven that you can put in, an amount that you can put in that is going to prevent you from, that will allow Emma's 30% to be added into Frank's 70%. As long as Emma puts in 10% property, 10% of property of her services, then she's going to be okay. So let me just explain this. So if Emma put her services 50,000, if she puts at least 10% of her contribution is going to be in property, so 50,000 times 10% is 5,000. So if Emma put in $5,000 of property, then we're going to say, okay, that's not a minimal amount of property. We're going to then say all that 30% is going to be added to the control group. Now, Emma's still paying ordinary income on all of her services for sure. But what it does is when somebody puts in more than a nominal amount, which is a 10%, is what the uh, courts have said, if they do at least 10%, so 5,000 here, then all of their shares, even the part that was attributable to their service, is going to be added into the entire control group. So in that situation, just that addition of $5,000 that Emma provides in property, now we have 100% control. And that means Frank does not have to pay taxes. So Frank's happy that he's not having to pay taxes right now. It's been deferred till a future period. Okay. So the way you get around it is make sure that the person who's putting in services is putting in at least 10% of their contribution as property. Okay. So you look at the value of the services and 10% of that, make sure that they put in at least that much property. All right. The final one, new shareholder into an existing corporation. So now we've got this existing corporation, and let's say on that last one, um, the corporation was is Emma and it is Frank. Well, now we have Tammy who's going to be buying into this corporation, and Emma and Frank aren't going to be contributing any additional property, so it's just going to be Emma who's going to be adding additional property. So what happens? I'm sorry, it's just Tammy who's adding the additional property. So what happens when a new shareholder is trying to buy into an existing corporation? Do we add all their shares together for the 80%, or does Tammy, in my situation, the new shareholder, have to meet the 80% threshold all on their own, right? So if you have a new shareholder entering this corporation, they need to meet the 80%, perhaps all on their own. The only way it doesn't have to be on their own is if the two existing or whatever number of existing shareholders also contribute property. If they're also contributing additional property, then they become part of the control group. But if they're not contributing additional property, then we don't consider the existing shareholders to be part of the control group. So let's look at our example here. Ivy owns 90% of Cardinal Corporation, fair market value of $900,000. Jack contributes property worth $100,000 for 10% new stock. Ivy contributes an extra $5,000 cash at the same time. Does 351 apply to Jack? The answer is going to be no, it does not. And why not? Because we don't have a contribution from Ivy that satisfies the requirements. Now, when we say a contribution that satisfies the requirements, what I mean is same thing with service. For Ivy to be part of this control group, Ivy needed to put in at least 10% of her existing value. So if she currently has $900,000, then she needs to put in $9,000. Okay, that's 10% of her existing contribution. If she had put in 9,000 instead of 5,000, then what would have happened is we would have said, "Oh, okay, that's fine. That's fine. Now we have 100% ownership between Ivy and Jack because we use all of Ivy's property. However, since she didn't put in at least 10% of her existing contributions, then Jack is on his own and Jack does not have 80%. Jack's stuck at 10%. So Jack is not going to get to use Section 351. So these are some of the unique scenarios that can arise in the 80% control. So again, we did the stock, right? The property for stock, and then we're doing the 80% control requirement. So that gives us both of those requirements. What I'm going to do now is I'm going to go ahead and I'm going to talk about what I think is probably the most challenging portion of non-liquidating distributions. And what I'm going to talk about is what is the basis that our shareholder is going to have in their property in the corporation, and what is the basis that our corporation is going to have in the property that they received. So we'll start talking about the issue of basis, which is very important to understand. Here's a look at our formulas that we're using when we're looking at calculating basis, both for the shareholder and for our corporation. So looking at the shareholder first, this is a formula you should be using. So What we do is we start out with the adjusted basis of the property transferred. So if you have property that has an adjusted basis of $100,000 and a fair market value of $300,000, we're starting out with the $100,000. Whatever the basis was in the property that we had that we're transferring into the corporation. So that's our starting point. Then what we do is we're going to add the gain recognized. Now, for determining basis, what we're doing to determine the gain recognized is it is going to be the lower of realized gain or boot received. So the lower of realized gain or boot received is going to be our recognized gain, which is what we're going to add to our adjusted basis. So if we look over under the notes, we can see the fair market value of the stock received. All right. So we go fair market value of the stock received plus the fair market value of boot received plus any liabilities that were assumed. And it doesn't matter if it was for a business purpose or a non-business purpose. For this calculation, any liabilities that the corporation is assuming that our shareholder would have previously owned. And we'll work through some problems, of course, minus our adjusted basis. So realized gain, again, is fair market value of the stock received, boot received, liabilities assumed by the corporation, so they're paying those liabilities off for us, minus our adjusted basis. And then boot received is anything other than stock. It could be the fair market value of property. Oftentimes it's cash, right? Because we're contributing some type of property and maybe our fair market value is greater than the fair market value of somebody else who's contributing property, but we want to be equal owners. Well, what the corporation may do is kick back some cash to us. That cash would be boot, so that way we're offset. All right. So we're taking the lower of those two, and that's going to be our recognized gain. So we have our adjusted basis plus recognized gain plus any ordinary income from service because we're already being taxed on it, right? That was ordinary income. So if we've already been taxed on it, we don't want to be taxed on it a second time. So we're going to add it into our basis. Okay, so that otherwise we would be taxed multiple times with it. And all of these where we're adding them back in is to make sure that any time that we're having to recognize gain, whether it's ordinary income from services or whether it's because boot received, we may have to pay taxes on boot received or the realized gain or to get to recognize gain. So if we're recognizing it for tax purposes, we want to increase our basis. And these two are going to result in taxable income to us. So that's why we're increasing our basis in the stocks because we've already been taxed on this. So we want to show it, have it reflected in our basis. All right, so those are the ways that we increase our basis. And then we subtract several things. We subtract the fair market value of boot received. Okay, so we've added it in, and then we're subtracting the fair market value of boot received. Now, you can see sometimes we're using boot here, and then we're subtracting it out, but we're not always using boot. Sometimes it's realized gain. It's the lower of the two. But we subtract out boot received. Now, with this part, this is important to know. It includes liabilities with no business purpose, okay, or excess liabilities over the liability basis. Okay, and we will work through a couple problems that show you how we deal with these liabilities. You see, if our liability that the corporation is assuming has a business purpose, then what we do is we subtract the liabilities assumed by the corporation that had a business purpose. We don't treat this as boot. That's not going to be treated as boot. Okay, so we're ignoring that for purposes of boot. All right, and that's going to give us our shareholders basis in stock. And then for the corporation's basis is easy. We start out with the adjusted basis of the property transferred. Okay, that's the starting point for us on the shareholders basis as well. So once we've calculated the shareholders basis, we know this amount is the starting place for corporations as well for the corporate basis in the property that they're receiving. And then we add the recognized gain by the shareholder. right here. So this is how we get to the corporation's basis. Okay, so and again, it's the corporation's basis and the property that our shareholder contributed to it. So the first portion, the formula for the shareholder's basis is going to be the shareholder's basis in the stock that they received. And then for the corporation's basis, it's for the property that they received that the shareholder contributed to them. So those are the formulas for us to be able to get to the basis. All right, what I'm going to do next is I'm going to start walking through some problems for you so that way you can see how these are solved. I'm giving you some pretty short problems so we can get straight to the issues with each problem. Here's problem number one. We have Sarah transfers property with an adjusted basis of $8,000 and a fair market value of $12,000 to a new corporation, Blue Devil Corp, in exchange for $12,000 worth of stock. Sarah is the only shareholder. What is Sarah's stock basis and what is a corporation's basis? All right. Well, let's take a look at it. What I have is our formula on the left-hand side in the gray boxes, and I did the calculations over here on the right-hand side so you could follow along. So our adjusted basis of the property transferred, well, our adjusted basis of the property transferred is $8,000. So our starting point is going to be $8,000. Then what we look at is the gain recognized. So the gain recognized is going to be the lower of the amount realized or boot received. Well, our amount realized is going to be our $12,000 that we're receiving worth of stock minus our $8,000 of basis. So we have an amount realized of $4,000. Boot received. We don't have any boot. Remember, boot is anything other than stock. All we received was stock in the first problem, so our boot received is zero. Well, zero is less than 4,000, so we're going 8,000 plus zero. We didn't have any services, so plus zero. Fair market value of boot received, well, we had zero, so zero there as well. And there were no liabilities with a business purpose that were assumed by the corporation. So that's a zero. So 8,000 plus zero plus zero plus zero plus zero equals 8,000. Our basis in the stock is going to be $8,000. Well, Sarah's basis in the stock, right? Sarah's basis, not ours. And then what we have is we have the corporation's basis. And look at this. We started out. Remember when we said, hey, it's these first two areas right here, right? Well, we started out with 8,000. Let's put 8,000 here and add gain recognized by our shareholder. Zero, they didn't recognize any gain because there was no boot. So zero. So the corporation has a basis of $8,000. We're done. We got this one. We got this one right. Okay, so that's the first one. Now I've got about six of these, so we're going to keep going through these, and they get a little bit more challenging as we go through, but that's the first pure example where we don't have any of the complications of boot or liabilities or service income. So pretty straightforward on that one. But let's now go to problem number two, and let's see what this problem brings. We've got a qualifying section 351 transaction. John transfers property with an adjusted basis of $10,000 and a fair market value of $14,000. In exchange, he receives $11,000 in stock and $3,000 in cash. Aha! That is boot. We've got boot. Okay. Well, let's go ahead and figure this out. What was the adjusted property in the property that we transferred to the corporation? And hopefully you're sitting there telling me, come on, I already know this stuff. It's right here is $10,000, right? So let's put our $10,000 in here. Now let's go ahead and let's look at the gain recognized. Well, our gain recognized is going to be the lower of our amount realized, $3,000 of cash plus 11,000 in stock. So we're receiving $14,000 worth of property minus 10,000, which is our basis. So our realized gain is going to be $4,000. And our boot received, we already knew was cash of $3,000. So what we did in this one is we're going to use the lower of the two for our recognized gain. Well, obviously 3,000 is less than 4,000, so $3,000. Hey, and if you're wondering, I mean, we're gonna keep working on this one. These two, guess what? I already know our uh, corporation is going to have a basis of 13,000, right? So I'm just going to peek down here. There it is. 10,000, 10,000, 3,000, 3,000. Boom. We have 13,000. But right now we're working through the top part of the problem. All right. So, ordinary income from services. It didn't tell us there was any service, so we don't have anything from there, so zero there. Fair market value of the boot received. Hey, that's the $3,000 of boot we received. It told us we received $3,000 of cash. $3,000 of cash, the fair market value is going to be what we received. That's fair market value of cash is the amount of cash we received. So we're going to go 10,000 plus 3,000 minus 3,000. That means our basis is going to be $10,000. So we have that problem too as well. We've done two problems now that we've been able to get through. This was your first problem with boot, which was an additional complication to the fact patterns we've been going through. And we already said, hey, we know corporations basis. It's these first two steps. So we already had the 13,000. All right, y'all. I'm sure y'all are hanging in there. Y'all are doing good on this, but let's keep working through some examples. Let's make sure that you know these. The more you see, the more confident you are, the better you're going to do, right? Okay, qualifying section 351 exchange. Dana transfers property with an adjusted basis of 6,000, fair market value of 8,000 for $4,000 of stock and $4,000 of cash. This tracks. We have fair market value of 8,000. We expect that we're going to receive $8,000 worth of compensation for it, right? So that makes sense. Well, let's see. We always start out with the adjusted basis in the property that was transferred. So we have 6,000 here. So let's put that $6,000 right there. So we have $6,000 for our adjusted basis plus the gain recognized, which is always the lower of the amount realized or boot received. Well, what did we realize? We had $8,000 worth of items that we're receiving minus $6,000 of adjusted basis. So we have $2,000 is our realized gain. Boot received is 4,000 because that is property other than stock. So we had 4,000 here. We're taking the lower of the two, so 2,000. So we have $2,000 here. Okay. Now what we're going to do, there was no service again, so that's zero, minus the fair market value of the boot we received, which was $4,000. Subtract any liabilities. We didn't have any business purpose liabilities in here. So what we're doing is 6,000 plus 2, which gives us 8,000, minus the fair market value of boot received. And what we're going to do is we're going to be down to $4,000. So our basis will be $4,000. Okay? Our basis is going to be $4,000. Now, over here, what we do is a corporate formula, the first two steps. 6,000 plus 2,000 equals our $8,000. Sorry about that. There we go. $8,000. Okay, so let's look at another problem. Problem number 4. We have our 351 transaction. Chris transfers property with an adjusted basis of 20,000, fair market value of 25. Subject to a $6,000 mortgage, and it's a valid business debt. So what's a valid business debt? Something like this. Something they took a mortgage out. The liability was used in a business capacity. So we treat that differently than if you took it out to go on a vacation or something like that, right? That's different. We treat that as boot, but we do not treat this $6,000 as boot. So let's go ahead because it has a business purpose. So let's go ahead and start out. Adjusted basis, well, we already knew that was $20,000. So let's go ahead and take the $20,000 plus the lower of realized gain or boot received. Well, what's our realized gain in here? Well, let's take a look at it. Fair market value of 25. Oops, I should have put something else here. Ignore that. 25,000 plus 6,000. That should be 31,000, right? That should have been 31,000 minus 20,000. Okay, and that should have given us $11,000 right there. So we have $11,000. Now, what is our boot received? Well, because this is a mortgage is a valid business debt, we don't have any, right? We don't treat it as boot received if it has a valid business purpose, and we do there. So we take zero is the lower of 11,000 or zero. So we go 20,000 plus zero, no services, no boot received. So those are all zeros. But now that $6,000, it wasn't boot, but what we do is it is assumed by the corporation that had a business purpose. So subtract the liabilities, assume that it has a business purpose. Right here's that $6,000. So we go 20,000 minus 16 or minus 6 gives us $14,000. Okay, that's going to be our basis in the corporation. And you can see the reason we're subtracting it is because we no longer owe that, right? We don't owe it anymore. So we're making sure we're taking that out. Our corporation, by the way, first two steps, 20 plus 0 equals 20. That's what we were expecting. All right, let's look at problem number 5. Just a couple more problems, y'all. We're almost there. In a qualifying 351 transaction, Emma transfers property, adjusted basis of 5,000, fair market value of 20,000, subject to an $8,000 mortgage. Emma receives stock valued at $20,000. All right. So let's see what we're doing here. We have $8,000 mortgage and we have $20,000 of stock that we're receiving. Okay. So let's go through and see what we have. We have our adjusted basis here of $5,000. So let's take that $5,000. And now what we have to do is we have to figure out the lower of realized gain or boot received. Now let's see something here, y'all. Let's just see something. Our adjusted basis is 5,000, but look at our liability. It's 8,000. So this is one of those little exceptions that we have to be aware of. If our mortgage is, or if our liability is greater than our adjusted basis, we treat that excess as boot, that $3,000 difference is boot received, even though this was for a business purpose. So, what we are going to look at now is the gain recognized as the lower of the realized gain and the boot received. Well, we're getting 20,000. Oops. We're getting stock of $20,000 plus $8,000 of liability relief. So that's $28,000 minus our basis gives us $23,000. So the realized gain, what we're netting here is $23,000. Now we look over here and we say, well, what is boot received? The liability exceeded our adjusted basis by 3,000. So we call that the excess amount. This is our excess. We call the excess boot. Okay, that extra $3,000 of that came from 8,000 of mortgage minus the adjusted basis of 5,000, that is boot. So we take the lower of 23,000 or 3,000. Well, 3,000 is lower. So now we're going to go 5 plus 3 minus, well, we don't have any liabilities, or sorry, we don't have any service income. We subtract out our boot. Okay. And then what we do is we subtract out the other part of the liability. So if you look at this, 3,000 and 5,000, what this really equaled was $8,000, right? So what we took was that $8,000 of um, mortgage, and we said to the extent of adjusted basis, that's just subtracting out liabilities, and anything in excess, that was boot received. So that's where the 8,000 came from. But 3,000 is boot, 5,000 is not. So if we go 5 plus 3, that's 8,000 minus 0, minus 3, minus 5. That's going to net out at 0. Okay. So we have a basis in our stock of 0. So anytime we sell our stock, it's gonna, we're not gonna have a return of capital. It's likely gonna be a capital gain for us. Okay. And then when we look at this, by the way, the first two steps for the corporation, 5 plus 3 gave us $8,000. So that's what we would have come up with. All right. I've got one last problem for this recording. We have a Section 351 transaction. Olivia transfers property with an adjusted basis of 20,000, fair market value of 30, subject to a $10,000 personal credit card debt. The corporation issues $30,000 of stock. Well, this here is a non-business purpose. Hey, let me tell you something. If we had a $10,000 personal credit card debt and we had $100,000, just say like a large amount or any amount of business purpose loan, this 10,000, because it's non-business, it taints all of our other liabilities. We're going to treat them all as non-business purpose. Okay. If there's any non-business purpose, all of our liabilities are going to be treated as non-business purpose. So let's take a look at this. Our adjusted basis was 20,000. So we start out with 20,000. Awesome. Then we're going to add our gain recognized, the lower of our realized or boot received. So if we're looking at this, well, what do we have here? All right, we have $30,000 of stock plus $10,000 of liabilities that we were relieved from. That's $40,000. We've got 40,000 minus our adjusted basis. So 40,000 minus 20, that means we had a realized gain of $20,000, but boot received is the non-business purpose debt. We don't have cash or anything. So we have $10,000 right here of boot. That means we take $10,000. So if we go 20,000 plus 10, we're now at 30,000 minus 0 because there's no service income. Then we subtract the fair market value of our boot received. Okay, well, hey, that was the $10,000, the same amount we use up there as the $10,000 of boot. There were no business purpose liabilities, so that was 0. So if we go 20 plus 10 is 30, minus 10, our boot, or sorry, our basis in the stock is now $20,000. And for our corporation, it's the first two steps. 20 plus 10 equals $30,000. All right, y'all. Those are 6 different types of formulas or scenarios that we can use when we're trying to determine what our basis in the stock is going to be, and then also when we're trying to determine what the corporation's basis in the property is going to be. I hope this video helped you. If it did, consider subscribing to my channel. I'm going to continue to do different videos, including like net operating losses and net capital losses, different things that accounting majors often struggle in their tax classes, or things that can be complicated as you're preparing for the CPA or the enrolled agency exam.